Hey guys, Allie Rathburn here with eXp Realty, and I'm here with Brody, my mini Australian Shepherd. So I'm going to talk to you guys today about what it really costs to buy a 300K home. So it's not like, you can just search on the internet, add a home to your cart in Amazon, and check out and put it on your Amazon credit card. It's a little more in depth than that, but it's more feasible than a lot of people think. So I know growing up for myself, I always thought you needed 20% down of the purchase price and that your mortgage was astronomical, but I have found out, obviously, as working as a realtor, I work closely with a few preferred lenders, and I have really come to find out all the different programs and grants that are out there, and not only for first-time home buyers, but a lot are for first-time home buyers, but a lot are for kind of anybody that makes certain amount, like 200,000, which is a lot of money. So most people qualify. So let's say there's a 300K home, which is you can get a very nice house for that price. And let's say that you qualify for a 30-year conventional mortgage at 6.25%. And quick side note, guys, anything below 8% interest rate, in my opinion, is good. Obviously, the lower the better, but in our industry, we say date the rate, marry the house, and divorce the landlord. So we say date the rate because if the rates ever come down to some crazy low number like they did in the pandemic, which honestly I'm not sure, in my opinion, if we'll see them that low ever again, but if they come down low to a rate that's very desirable, you can always refinance with your mortgage company, your lender that you initially worked with. And also another side note is when working with a realtor, they should have a few preferred and trusted home lenders that they work with and that they have a good business relationship with. So that is a key factor when choosing your realtor. A lot of times people think you need to get pre-approved first before you talk to your realtor, but in my opinion, it's best to talk to a realtor first and get their opinion on who is good in the area, who knows the local market, who is trusted by other agents as well, because you have to remember you're putting in an offer on a home, and that listing agent is going to see who your mortgage is by. And if it's by a mortgage lender that they either don't trust or they don't know, they're going to pick the other offer over you, because if that other offer is by a local lender that is trusted in the area. So just quick advice is to stay away from big banks and to stay away from online lenders such as like Rocket Mortgage and stuff. They're great to add to when you're interviewing different lenders, but they can be inaccurate, and they also can be very hard to get a hold of. So sometimes a quick phone call is what is holding up a transaction and can break the deal and stop it from going to closing. So those are my little my advice to you. So we have a 300K house, and we're qualified for a 30-year conventional mortgage, and we're going to put down 3%. So that's $9K. So right off the bat, you have $9K out of your pocket that you're putting down. Then you're going to have closing costs. Brody, you don't know what you want to do. Get down. So then you're going to have closing costs. And a lot of people, this was me before, don't realize how much closing costs are. I always thought it was the down payment that was the majority of the out-of-pocket costs, but it is really the closing costs. So the closing costs are basically like fees and upfront payments for your loan. It can also be like deed transfer fees, transfer tax. Certain cities have more transfer tax than others. Philadelphia is a little bit higher than some of the surrounding counties, for example. So it's fees like that, and they add up quickly. So for this scenario, for this loan, we're going to pretend that you have a car note of $800. You have credit card payments a month for $150, and you have student loans for $200 that are $200 a month. So that's your debt. Now, your closing costs, like I said, are all those fees and prepaid payments and stuff like that. And for this $300K house that has, every house has a property tax amount depending on the township it's in. So a typical property tax per year for a house in, in like Delaware County or even in Chester County, it can be around like $5K for a $300K house. So your property tax as well is going to, some of those payments are going to be in the closing costs, as well as some of those payments are going to be dispersed through your monthly mortgage payment. So I did all the math for your closing costs, and so with your closing costs and with your $9K down payment, you're looking at around $25,000 is what you would need to purchase this $300K home. And, that's a lot of money. Most people don't have $25K waiting in a bank account to be spent on closing costs for your home, for either your first or your next home. So like I said, a lot of lenders have programs and grants. And what is Brody getting into? Stop it. So, Brody likes to eat my makeup. So one of these amazing program and grants that I was mentioning that a lot of lenders have is one by Princeton Mortgage. They are one of my preferred lenders, and the program is called CapCut. So what it does is it will essentially loan you up to $15,000 towards your closing costs, and it is a forgivable loan. So if you are in your house for 10 years, after that 10 years, that loan is gone. It's completely gone. It doesn't affect your credit. You won't ever see or hear about it again. So instead of $25K, you only need about 10K. That's a lot more feasible for most people nowadays. Now, it still is a lot, and it's a wonderful program, and it's forgivable. It doesn't affect your credit, and $15,000 is a lot of money. So now let's say if you don't stay in your house for 10 years. Let's say if you stay in it for 5 years. So instead, then you would have to just, when you sell your house, the profits from that, part of the profits from that sale will be paid back to the CapCut program or to Princeton Mortgage. So it would only be half of the loan, half of what they gave you for the closing costs. So let's say they gave you the $15K, half would be $7,500. So you're in your house for 5 years. You know, you're doing great, you're building, you're making your payments, your equity's going up, and you want a nicer house. So at 5 years, you sell your house, and it just comes, $7,500 comes right out of the profit, and you don't even have to worry about writing a check to them or anything like that. So let's talk about the monthly payment. So your monthly payment for this mortgage with this scenario would be $2,532.39, and that includes principal and interest, as well as your mortgage insurance, your home warranty payments, and your property tax payments, because if you don't pay your property tax, you can lose your home. So the insurance, the lender will take care of that for you and wrap that all up into your one or each monthly payment. It'll be dispersed throughout. So what you need to make for this 300K house is you and your partner, or just you, need to gross $8K per month. So you could do $4K and your partner could do $4K, or you could do the whole $8K, and that would be $96K per year. So that is what you would need to make in order to qualify for this scenario. With the the debt that I had described earlier, with the car loan and the credit card payment and the the student loan payments. So this is kind of an average scenario for an average couple nowadays. So I hope this really helped you guys. And I hope you can kind of have a grasp on what you would need to pay out of pocket and what your monthly payment would be. So I really hope you learned something, and please, if you're looking to buy or sell, please reach out to me and I will get you in contact with some of my preferred lenders, and I will also take wonderful care of you. So thank you so much, and I hope you guys learned something today. Bye guys.